Review for May 23rd, 2024. This day was essentially just a giant vacuum test of the exhaustion gap. And if you've been watching my videos, I've been saying I thought that this gap was exhaustion. And you can see that's basically the exact price that we tested to. Went a couple ticks past it, but we were trying to test this high. And the reason we were trying to test that high is because bears who sold above this high and scaled in higher, maybe at a new high, should make money, since this was probably a leg in a trading range. And now this is probably a leg in a trading range as well. So you're expecting the market to probably start to go sideways pretty soon. Let me turn the study. Perfect. But yeah, we also got a measured move down of the wedge. You can see we had a wedge 1, 7, and 19. It's a little lower. I missed it by a tick. But in this general area is also where the exhaustion gap was and where a measured move down of the wedge was. So there was a lot of reasons for us to head to that particular spot. Bar 1, a bear bar closing near its low. It's good for the bears. It's a gap up above the prior day's high, and a big bear bar closing near its low after a gap up. Generally, a setup like this, I would say 30% chance that it's the high or the low of the day. Usually any given bar, so a bar like this or just any given bar on any given day, has about a 20% chance of being the high or low of the day. But if you have good context, it can go up to as high as 30. And I think this is the proper context where usually if you get a big gap up and a big bear bar closing near its low, it's 30%. Or if you get a big gap down and then a big bull bar closing near its high, that would also be 30%. Bar 2, a doji bar, but it is follow through for the bears. It's the minimum follow through, but it's still follow through. So if you're a bear selling below 1, generally you're looking for probably better follow through than that. But as long as it is not a bull close, it's still considered follow through for the bears. So because of that, some bears will sell the close of 2. Kind of follow through on 3, but it's more of a bull reversal bar than anything because it closed above its midpoint. And if you had sold below 1, 2, and 3 are rather disappointing. You essentially got consecutive doji bars. However, we still are in a bear microchannel so far in the day. Still a reasonable chance that this is the high of the day. If you're selling below 1, you're probably either scalping out quickly or, I guess there's a couple different ways to manage it. You could sell below 1 and sell more above 1. You could probably sell below 1, put a stop above, and just take a chance that we do this. And again, you might only be right 30% of the time, but when you lose, you'll lose 12 points. And when you win, maybe you make 6 times that. So the math makes sense to do something like that as well. 4, follow through for the bears. So it's a big bear bar, but it's closing. It closes below its midpoint, but there is a big tail. And we had a relatively good bull rally into yesterday's close, and we had the big gap up, which is essentially just a giant bull bar with the Globex session. So pretty good for the bears so far, but we're probably going to run into support rather soon, is my point. Big bear bar closing somewhat near its low on bar 5. Good for the bears, but I think we're pretty overdone, and we're probably going to bounce pretty soon. This could be this definitely has the potential to be a big bear trend day, but are we going to sell straight off? Probably not. This is too climactic and relatively unsustainable. So I personally would rather wait than selling the close of 5 or selling below 5. 6, a bull bar, but a big tail on both sides. I think it's probably reasonable to buy above 6, thinking that it's a sell climax and the bears who are short. I mean, think about it. If you were short anywhere in here, you're probably just going to exit above 6. And the risk is relatively small. So even if you just get bears to exit, you might get some sort of bounce. And what are traders looking for? They're probably looking for a bounce to the 3 low. Why the 3 low? Because bulls bought below the 3 low, expecting it to be able to scale in lower and it to get back to their entry price. You only know that because, it's not really good to sell on a stop below bar 3. Therefore, more traders would probably be looking to buy it. So it's unusual when they get trapped. And so if this is going to be a trading range day, those limit order traders who scale in are going to make money. So we should get back to the 3 low at some point, which you can see we did over here. 7, a big doji bar. You can see we traded below 6. If you bought above 6, your stop probably needs to be below 5, not below 6. Some traders would buy more lower. A big outside up bar, but it essentially closes at your entry price. So this is a lot more of a trading range bar in my mind. 8, a bull bar. It's an IOI pattern, inside, outside, inside. So a little bit bullish. Traders buying above 8, what do they want? They want a vacuum test of the 3 low, in my opinion. So if I was buying above 8, first off, I didn't like the fact that 6 had a tail that was disappointing on top, and 8 had a tail that was disappointing on the top. So if either one of these bars closed on their highs, I thought they were better trades. But instead, they kind of closed near their highs, but with a conspicuous tail. And you don't really want to take as many trades with conspicuous tails once you have, when you're trading against this big of a sell-off. You want the bars to be relatively perfect. So they were reasonable to take, but I just don't think they were all that ideal. And you have to think about bar 9 pretty deeply when you see it, right? Because if you bought above 8, you wanted a vacuum test of the 3 low. And if you're going to get a vacuum test, it should move rather quickly. And instead, we got a decent amount of the way there, but there's still enough room to buy the close of 9 and make basically a 5-point scalp. So if there's so much edge, why did it not get erased quickly? And that should be your thought process. If you bought above 8, you wanted to see a vacuum test right to the 3 low because there was so much edge for the bulls. But instead, you got kind of a, 9 it's subtly disappointing in a way because it's just confusing, right? It doesn't make logical sense that we didn't get vacuumed straight to that close, because if you were buying above here, you thought it was a high probability bet that we were going to get a quick bounce. Instead, you got this. So 9 should make you question your premise when buying above 8. That's why I think a lot of traders ended up selling out above 9 rather than buying more. 10, a bear bar, but a big tail on the bottom. So not all that good. It's a low. I suppose it's a low too short for the bears, but and after a really big sell climax. But I think we need to go sideways more first. I wouldn't sell below 10, and then I definitely wouldn't sell below 10 and expect it to go straight down. It's probably going to go more sideways. You do have the open gap with the 3 low, which is good for the bears. But again, this is probably going to go more sideways to down rather than anything. 11, follow through for the bears, but a big tail. It's a bit disappointing. It just seems to be a vacuum test essentially of the 5 close. So probably going to be still a bit more sideways here rather than straight down. 13, a bull, or 12, a bull bar closing near its high. It's a big double bottom with 6, and the neckline is the 10 high. But am I buying? No, I don't think I would. I don't think I would take that buy. You're buying kind of in the middle of this trading range, even the upper portion of the trading range that we've developed here, and you're buying after a sell climax. Oops. So if you think about it, how often are you going to get 13 as a huge bull bar closing near its high? Not very often. The more you see this kind of setup, the more you come to realize that it's probably just not going to be a big rally all that often. So I would not buy above 12. I'd rather wait and see what happens. Disappointing follow through on 13 is relatively expected. You can see we tested back to the 11 close. So some traders, they sold, they scaled in higher, and they're using 13 to get out. That's probably one of the reasons why traders are buying back shorts, and that causes 14. Something to notice is bulls are getting really strong closes, 12, 14. So I thought that that kind of segues into bar 15, right? 15 is a double top with 11, and neckline is 15 is a double top with 10, and the neckline is 11. So bears want to sell below 15 and go for a measured move down somewhere down here. And I thought 15 was a good sell. But the big problem with 15, I think, obviously it's on the moving average, which is never, all that great. But it's definitely a reasonable swing trade. It's just not as great of a scalp. But my big problem with it is how big of a bull bar that 14 is. Whenever you have a situation like this, I had this same problem with selling 42, essentially. It was obviously the context was different. But if you just look at this pair of 2 bars and these pair of 2 bars, when you get a bull bar that's that big and closing near its high, it should make you really suspicious about bar 15 because it's a reasonable swing sell, but why is this such a good bull bar? And if this is not a bear trend day, then it's probably a trading range day. And if it's a trading range day, then we're going to end up getting back up here. It doesn't mean we can't go down first, but it should make you suspicious of this sell-off, how strong bar 12 was, how strong bar 14 was. So I think that while this is good for the bears, it's probably not going to turn into some sort of major reversal because of how strong these bull bars are. Traders who sell below 15, they get good follow through on 16. Some traders were suspicious of 14, so they didn't sell below 15. Instead, consecutive bear bars closing near their low. We probably never really went always in long, but I think we're definitely back to always in short below 15. And you get follow through on 16, so always in short, sell to close. Traders sell below 16, they get good follow through on 17, good follow through on 18. You can see we're towards the bottom of this channel line. And if you're selling down here, your risk is really big. So it's hard to sell once you start getting all the way down here. And that since these bull bars were so big, it might end up being a trading range day. And if it is a trading range day, the bulls who are betting the breakout's going to fail below bar 5 are probably going to make money. So that a lot of times will make bar 18 more of a big bar like this, more of a profit-taking bar than a sell to close bar. We're also near the bar 76 low, which is a possible magnet. 18, a bear bar closing near its low, and you get disappointing outside up 19. Traders started taking profits. Once it didn't race down, traders started taking profits, and that's what caused the rally on 19. And you can see a couple things. One, it's a failed breakup below the 18 bar range, so bulls are hoping that we're going to get a big rally and get back up to this high. Probably not. It is a wedge, 1, 5, 18. It's kind of it's just, I prefer to say it rather than draw it, because if you draw the line, it looks like that. So it's a bit of a messy wedge, but it is a wedge. You can probably buy above 19, but big bar, big risk. So some traders, instead of buying directly above 19, look to buy the 50% correction of 19. And that's exactly what happens on bar 20. 20, a huge bull bar closing near its high. It's good for the bulls. It erases a lot of the edge from down here. Something about bar 18, while it wasn't good to sell bar 18, it was theoretically reasonable. And if this is a trading range day, which it's proving that it probably is, we have strong enough moves down that we're probably not getting a bull trend day. And we have strong enough, bull bars 14, 18, or 19, 20, that it's less likely that we're going to get a bear trend day as well. So reasonable to think that we're going to get back to this 18 close at some point. Big bull bar closing near its high 20, but now you have really huge risk. So if you're buying above 20, your stop is below 17. Obviously, if you're doing that, you're probably going to get out before, it's below 19. Obviously, if you're buying above 20, you're probably going to have to get out before it hits the 17 low or the 19 low, because the reality is there are probably more buyers down here than sellers. So it's not really great to buy above here and put a stop down here and let it get hit. If I took the buy, I did not. I would put my stop here, but I would get out a lot faster. You can't just sit and let the stop get hit. 21, disappointing follow through bar, a big tail on the bottom. And you can see 22 tested back to the 20 close. So some traders, they bought the close of 20, hoping that we were going to continue to rally. They know we're probably getting back to this 14 close and probably getting back to the 3 high. So some traders bought and took a chance, even with the big risk that we were going to get the rally immediately. And a lot of those traders scale in maybe below 21, and they use the rally on 22 to get out. And that's why we continue sideways here. 23, it's a high 1 for the bulls after a spike. It's an incredible buy above 23, I think. It's a high 1 in a bull trend. If you're arguing that 19 and 20 is the bull trend, the problem is you're near a sell climax high. But some traders take the buy because the risk is less, right? So you have much lower risk. You can buy and put a stop below 22, but that's kind of tough to do because you know that a lot of times high 1s like this will lead to deeper pullbacks and then trend resumption. So there are a lot of different ways to manage that trade. 24, follow through for the bulls, but not as good as it could be. A lot of traders who didn't buy above 23 were scared of getting trapped. And now that we have follow through on 24, they'll take the buy now. And that's why you get some follow through on 25. You can see the entry price would be 55,333.25. And so if you look, we tried to pull back to it. After traders saw that 25, 26, a lot of traders will try to get filled at the entry price after they've had the follow through. So their probability is a little better and they'll try to get in at the same price. And if you waited until after 25, you were not able to get in on 26. And when it was stalling down here, a lot of traders realized that it was stalling. So what they did was they just bought the market instead, giving up on trying to get the better fill, and just took a slightly worse fill, but higher probability, buying the market there. And that's why we get the rally on 26. An inside bar 27. I'm not selling anything just yet. It could be a parabolic wedge, 21, 26, and then, maybe 29, 30, or, whatever. Maybe it would have been 31, 32. But the point is, I think we're getting to the 3 low, and I think there's going to be sellers there because the bulls who bought below here and have scaled in are obviously disappointed. 27, 28, inside pattern. Do you buy above 28? I wouldn't. I think it's an II. It's more of a final flag. And you have to look at the context of the day. With how far down we've gone today, do you really think that we're just going to get a huge rally and this is going to turn into some kind of bull trend day? Probably not. So it's really not all that great to be long here unless you get a new breakout. So you want a new breakout essentially above this channel line if you're going to be looking to buy. And 28 could be the start of it, but I'd rather wait and see what it looks like. And plus the 3 low, there's going to be sellers there. So that's a magnet above. 29 pets the 3 low, and you can see we found sellers, and then a reversal down 30. 30 is a parabolic wedge, 1, 2, 3. So okay to sell 30, but you have to think about your goal if you're selling 30. Are you selling 30 hoping for a major trend reversal? No, you're selling 30 because it's a parabolic wedge, so you're selling a small bar high in a trading range. And if you're selling it, what are you looking for? You're looking for 2 legs sideways down. So 30 could have been the first leg, and then you can see we got the second leg sideways down. But for the Bears, it's not that surprising that you get 31. Disappointing follow through because this channel is relatively tight, but you still should get a second leg sideways to down. So you might have to use a bit of a wider stop. You definitely can on this kind of trade, and just if you get a bull bar closing near its high, you get out. But a lot of traders, they sell and they get out at a 5-point scalp, which is somewhere in here, or it's more like right here. But a lot of traders would just take the 5-point scalp, because the reality is once you get 32 and 33, the edge for the Bears is gone. The sell below 30, what were you expecting? 2 legs sideways to down, and you got 2 legs sideways to down. So there's not really a reason to hold this short. So for me, I think if you sell, you got to scalp out. And 32. So where was it? Okay, so 30 parabolic wedge, 31 disappointing follow through. Not all that surprising. You can see we tested right back up to the 29 high. On some lower time frames, some bulls ended up buying the exact high, and since it's a trading range, those traders should get out at break even. So they bought, maybe they scaled in, and they used the rally on 31 to get out. 32, a bear bar, but a big tail on the bottom, so not really as good as it could be. Again, it's follow through for the Bears, but you know that this whole thing is a minor reversal, so you need to be looking to try and scalp out low. I think at the lowest, you probably want to get out, try to get out around the 22 close, but once you get disappointment 33, a lot of traders are just going to exit the market, and that causes 34. And I think the final Bears exit above 34. But I think if you're selling below 30, you probably have to get out sooner than above 34, because you have to recognize it's more of a scalp, at least in my opinion. So 34, a bull bar closing near its high after a bit of disappointing follow through. I think in the middle of a trading range, you can maybe buy above 34, betting that, this is the wedge, and it was a tight bull channel. So we're going to get a second leg up, and maybe we get a breakout above. 35, follow through for the bulls. It's okay to be long at this point. You have consecutive bull bars, and we are probably always in long. I think that we became always in long somewhere in here, and we were never quite able to flip to always in short. So when I had thought, when I had mentioned that you needed a new breakout, I thought this could be the start of the new breakout, and bulls could get a pretty solid rally here if we broke out above the high of the wedge. And you get you get more follow through 36, a bull bar closing near its high. So you have 3 consecutive bull bars, good for the bulls, probably going at least a little bit higher. Expect a second leg sideways to up, which you do get, by the way. The tail on 38, believe it or not, is your second leg sideways to up, giving you that chance to get out. But 37, a bear bar, disappointing. So if I was long, I was long, but you want to, if you're taking a buy in here, you're hoping for a bull breakout. So you're betting on a sense of urgency and that the market's going to get a breakout above. So this is not a trade where you can tolerate a deep pullback. If you're buying up here, it's relatively risky because you're buying high in a tight trading range, or in an overall trading range. So you need to be quick to get out. So I think bulls will exit below 37. And if you watched the bar, there was a micro gap up on 38. And essentially what happened was bulls bought the close of 37. Well, first off, there are some bulls who don't want to risk this much, right? So they see 34, 35, 36, and they think, well, maybe it's a bull breakout, but it's kind of hard to buy up here because the stop is really far away. So then they see 37 close near its low, and they think, okay, cool, I'll buy the close of 37 and put a stop below 37. So now they have, their probability is obviously much worse, but now they're in at a reasonably similar price, and they have a very tight stop. So that's why we got the micro gap up on 38, because some traders bought the close of 37, causing the micro gap, and just put a stop below. And if you watch, you can see for the first 3 minutes of the bar, here, I'll show it on a lower time frame. But for the first 3 minutes of the bar, you can see for the first 4 minutes of the bar, right, we were holding strong above that price. So we were holding above the low of 37 for the first 4 minutes of 38. What happened? Well, bulls, they bought the close, right? They were hoping that we were going to get the breakout above the wedge. And eventually it just didn't rally quick enough. And so what they did was they said, okay, well, I bought the close. I have basically a 1-point scalp. So those traders just exited. And that's what causes the bear bar closing near its low 38. I think lower high major trend reversal. So you have this trend line, and then you have the trend line break, the retest, and then lower high major trend reversal 38. So okay to sell below 38. Additionally, if you're selling 38, what makes it so good is you're selling a small bar relatively high in a trading range, and you have a really important magnet, I think the 18 low below. Follow through on 39 for the bears. Good for the bears, probably going at least a little bit lower. More follow through on bar 40. So again, good for the bears. This is sell to close. We're going to the 18 low at this point. It's very likely. We'll probably go straight there. The thing is, once you see 39, if you pull back again, traders will start to question whether we're going to the 18 low, because we probably, if we're going to go right now. Once you get 38, 39, this is the best looking setup. And I can't, if we pull back and then get another setup, that setup's not going to be as good. So we should go right now since we have the clear lower high major trend reversal. Follow through for the bears on 40, good for the bears. More follow through on 41. I still thought at this point, probably like in a trading range, we might go lower, but I need a strong breakout. I would probably be looking to exit down here. These seem like more profit-taking bars. Follow through for the bears, 41, 42, closing near its low. Good for the bears, but we're getting really close to the magnet. So that's why you can see we're starting to get tails, 41, 42, and the momentum is starting to dry up. 43, another tail, so more disappointment for the bears. And so the question becomes, well, why aren't we reaching the 18 low? Well, it was better to sell up here because you're risking a small amount, right? Even if you sold below 39, you're risking 8 points trying to make 15 points, and we're probably going here. So that's why you're getting these good follow through bars. But what about now? Well, now if you're selling down here, you're trying to make 3-4 points, and your risk is like 20 points. Obviously you have to get out faster than that, but that's why we start to go sideways here, because the risk reward is no longer good to get to the magnet, which is the 18 low. 43, follow through for the bears, but a big tail. Just check something. Okay, follow through for the bears, but a big tail. And then an inside bar, 44, and a doji bar. When you get a doji bar in sell to close trend, it's probably going to be the end of the sell to close relatively soon. So what do traders do? Well, if you're short and you see the doji bar, is it worth holding to try and make an extra point or two? If you sold it, and you're probably already at a pretty good profit. And so is it worth holding to try and make an extra point or two? Some algorithms will, but I think for most traders, you can just exit. And when we trade below 44, a lot of those traders do that. They just exit, and that's what causes the bull bar 45. You're not buying above 45 because it's just bears exiting and you have a really tight channel down. So that's not really a good trade at all. But some traders, some algorithms, what did they want? Well, they wanted better risk reward, right? So they don't want to sell down here. They know we're going here, but they don't want to sell all the way down here. Instead, they'll sell above 45, knowing that this is going to get a second leg down, and they're betting it's going to get to the 18 low. And then we get an outside down 46. So it's an 00, 45, 46, 60% chance of some sort of measured move. At this point in the day, we'll probably get one more swing. A lot of times when you're, I have the mental thought, at least when we're around bar 40 and we're going sideways, or we're probably going to start to go sideways, I usually think to myself, probably one more swing left today. So, I think a lot of days get like 2 swings that are pretty credible. And this was obviously a good swing. And I thought that, when you're in this area, what's either going to happen is we're going to go sideways until like bar 60 and then get a reversal up and back up into this area, maybe the 33 low, or we're going to get what we got and get the breakout down. So your job as a trader is to identify what both sides want to see and how it's going to look if they start to get it, and then trade accordingly, right? So you don't know in here that we're going to get for bar 50, but once you see 50, you know that's what the bears wanted to see to try and get a breakout down and a measured move below the wedge. So 46, 00, it's an okay sell, but my problem was I thought that there would be buyers around the 18 low and here. So I personally, while it's reasonable to sell, I would personally just wait for the breakout. 47, bad follow through for the bulls, for the bears. So this could be some sort of final flag, and we're trying to get a breakout below, and it might be failing. 48, a bull bar, but is this going to start the bull trend? Probably not, considering the fact that 47 was a doji bar, and good bull trends do not start with doji bars. So I think the best case scenario for the bulls is we test back up to the 45 high. 49, a bear bar closing somewhat near its low. It's good for the bears. I think that we're probably going at least a little bit lower. I'm not sure how much. You can see this measured move down is a potential target. And then you get the bear surprise on 50, and 50 changes the dynamic of the day, right? You have an open gap here, and the traders who bought above 45 were willing to scale in lower, and now they're trapped. Some of them bought above 45, bought more above 47, and those traders got out, and that's exactly why 48 went where it did. 50, a big bear bar closing near its low. So, by the way, when you buy above a bar like 45, it's not a good trade, but 60% chance if you scale in, it's going to get back to your initial entry price, and 80% chance if you buy again above some sort of bar, a bull bar. This wasn't a bull bar, so maybe it wasn't credible to add on here, but it went to the exact midpoint of the two. So some traders bought here and scaled in. 80% chance you're going to be able to avoid a loss, and that was your chance at avoiding a loss. 60% chance it gets back up here. So huge bear bar, breakout below 50. We're probably going lower. And again, at this point, I'm thinking that about the exhaustion gap that we have on the daily chart. A lot of times when you have a magnet like a gap on the daily chart and it's pretty obvious, the market will try to fill it with one big move. It won't drift down to the magnet. Once everyone agrees that we're probably going there, traders start selling, and that's when you get the big vacuum test. And similarly, the same way that on the five, that's on the daily chart, right? And on the 5-minute chart, when I think we're going to close this gap, I want to see a vacuum test, right? I don't want to see a slow move up. And on the daily chart, when traders want to see the move down to here, they don't want to see a slow move down, because that tells you that not as many traders are paying attention to it. Because if everyone was paying attention to it, then it would be moving rather quickly. So huge bear bar closing here, it's low 50. But the problem is your risk is now above 48 and you're selling below here. It's okay to sell below 50, but what some traders do, which I always say, they look to sell the 50% pullback instead. And what's interesting is if you look at this bar, when we are right, so look, the first minute of the bar, essentially, we rallied to the 50% pullback. It might be 2 minutes. No, it was the first minute. Okay, so think about it this way. We're 1 minute into this bar, into bar 50, and you're staring at your 5-minute chart, and we're 1 minute in. We have 4 minutes left in this bar, and the bar is sitting right here at the 50% pullback. What are the odds that we're going to continue to rally and just get a huge bull bar? Really pretty low. So over the next 4 minutes, it's more likely that we start to sell off and at least test back down to the 50 close. So that's why a lot of traders take the sell. They know that occasionally maybe we'll just rally and it'll close somewhere up here and they'll get stopped out. But they're not really losing all that much if that happens. And if it closes on its high right here, they'll just get out. So their risk really isn't all that big anymore. And there are a couple different things you can do. Some traders, if it starts to sell off, they'll just take the scalp. Other traders wait to see what 51 looks like. If 51 was a bull bar at all, those traders would scalp out and then we'd get a bounce, because the traders who are holding are hoping for a swing. And when 51 is a big bear bar closing here is low, that's exactly what they wanted. So instead of, if we got a small but doji bull bar, those traders just scalp out and take their 5-point scalp and then it bounces. But instead, big bear bar closing here is low, traders think, oh, well, now maybe I'm going to make a swing. So they hold. 52, an inside bar, a low 1 short for the bears. It's okay to be short, okay to be holding short, and follow through on 53. Big tail on the top, a tail on the bottom. More follow through for the bears, 54. Again, okay to be short, but the risk is getting really big. We're probably getting here, but it could do something similar to this where it starts to go sideways before it gets to the magnet. More follow through 55. You're selling really low. It's a big bear bar closing here. It's low, but it's pretty climactic. And you get disappointing follow through 56. The bears exit above 56. In theory, you don't have to, but I don't know. I would probably get out because the pullback, the bounce could be reasonable before we get back to this low. So I think I would just get out above 56. Some bulls who are, trading really riskily will buy above 56 and probably scale in. You can see the 55 low. A lot of these trades that I'm talking about, the management seems impossible, and it is. It's insanely hard. So don't do things like this, but it's what some algorithms will do, and it's just an explanation of support and resistance. You're not consistent enough. I'm not consistent enough. Pretty much no one is, to buy, Al probably can, but he's basically an algorithm. Traders buying above 56, maybe they scale in more at the 55 low because they know the bears who sold here are disappointed with this. So there is logic to buying and scaling in here and using the rally on 58 to get out, but it's such an insanely hard thing to do that, being able to do that consistently, it would be really, really difficult. So it's just an explanation of why is the tail on 57 exist? Because traders who sold below here are disappointed in this and they're getting out. So that's causing this. Well, why did we sell off so sharply on 58? Because any bull who bought and scaled in is disappointed in this and they're selling, and that's causing 58 to close near its low. Do you sell below 58? I probably wouldn't. It's a big bar, big risk, really low in a trading range, or really low in a bear trend. So hard to do. 59, big doji bar. If you sold below 58, that's not the follow through bar you wanted. You wanted to see something like this in a new breakout. Instead, we're going sideways. 60, sellers above 59. It's a bad high 2 for the bulls, but a bad low 1 short below 60. So more buyers below. But you're not buying above 61 because even though it's, potential wedge 1, 2, 3, we might get a bounce, but it's going to be minor and it's a bear bar. So we're still in a bear trend. It's probably converting into a trading range, but we're still in a bear trend. 62, a big bull bar closing near its high. To me, that's the end of the bear trend. We have a decent bull bar, 56, and a good bull bar, 62. So probably more than anything, this is going to start to go sideways. And then a bear bar closing near its low, 63. I wouldn't sell. You probably can because you're selling the top of the channel. So, but you have to realize this is not a bear trend or a big bear trend anymore. This is a channel. And you can see follow through 64, 65, and we channel down to the magnet. I would not be selling down here. This is a profit-taking area. Disappointment inside bar 66. Some traders who are selling, they get disappointed with 66 because it's such a small bar, and they can see that we're on the channel line, so they just take profits, and that causes the bounce 67. Bad low one short 67, buyers below. But I wouldn't take that because we're in a bear trend. 68, reversal up. You can see there are buyers below, but they're scalping out. Traders buy below again. I wouldn't sell in here. It looks like a couple legs sideways up, so I'm not looking to sell 71. For stop orders, one was pretty reasonable today. Obviously, then we went sideways. And if you look what 77 did, we tested back to the 63 or 62 close, which is confirmation that this is a trading range, because the traders who bought above here, it was a big bull bar closing near its high, so they know it's probably going to come back to it. And they scaled in and made money. Stop orders, one is reasonable, probably 15, 16, 17, 18 you're selling pretty low. You probably buy the close of 20, 23 makes some sense. 30 definitely, and then sell the close, 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 but getting low. The O is probably reasonable. And it's always in short, bear bar closing near its low, always in short still, bear bar closing near its low, but maybe the bottom of a trading range. But okay to be selling bear bars closing near their lows when we're always in short. Again, we were always in short here, probably became always in long somewhere in here. Stayed always in long, I would say, through this minor reversal. So that's why it's a scalp. And some traders will buy above these because it's bull bars closing near their high when it's always in long. Probably became always in short 39, definitely by 40. And this doesn't make the market always in long, so it's still okay to sell these since bear bar is closing near their low, always in short. And then it's sell the close, but hard to sell way down here. And probably okay to sell 63. On the daily chart, well, obviously it's Saturday, right? So this is a review for Thursday. So I can't, I can tell you what happened tomorrow, but generally when you get such a big bear bar and it tests this, you're going to get something disappointing the next day. The same way when we got this bar, we got something disappointing. To me, this bar means that we're probably in a trading range now. Bulls were hoping that this was going to turn into a big bull trend again, but probably not, probably more of a trading range. And I think that bar signifies that we are now in a trading range. And I discussed the weekly chart and stuff in my prior video, but when you're getting, when it's Thursday and we had such an important thing going on up here, because bulls had gotten a close above the breakout point. You can see they got a close above the breakout point and they wanted to get another close above it. But instead, or on Thursday, it was a close just barely below it. And bulls on Friday wanted to get a rally and a bull close, but they were not quite able to, as we saw on Friday, because then they wanted consecutive bull closes above the breakout point, but they ended up getting it. All right. That's the